Let's talk to Tim Gregory. He is the Chief Investment Officer for Vermeer Investment Management. And a very good morning to you, young Tim.
Morning, Nick.
Right, saw you 2 weeks ago. A lot's happened in the last 2 weeks. The markets have rallied like a homesick angel. What's the field position for you now?
Well, we haven't changed our view, which, of course, you could say to me, well, 2 weeks ago you said the market's going to be range bound. It's going to be very difficult for the markets to get out at the top end of the trading range, which, obviously is what I did say and what I do think.
Yep.
So we are on the S&P 500, roughly 100 points still below where that peak of the market was seen. And, I think what we're seeing is that if 10-year US Treasury yields have steepened to 3% and the market can get comfortable that that is going to be that, and that's the end of it, then everything's going to be okay. To me, that sounds very convenient that 10-year yields just literally stop
at
3% conveniently for everybody.
Well, it's quite interesting that I think it was Goldman Sachs saying that the markets, in terms of the yields, only get into trouble when we get up to 4.5%. And the vast majority of the S&P 500 companies who borrow money are fixed anyway. So therefore, the yield curve doesn't really matter to them.
It's a very good point about fixed bonds, because a lot of companies have used this very long period of low interest rates to borrow as far out as they could at very low rates. I mean, the question is for the investors who bought those very low rates, if bond yields did go to 4, where those bonds would price. But for the companies who actually borrowed the money at those rates, that's still going to be a good deal. So, whether it's 4%, as Goldman Sachs suggests, I'm not sure. But if we saw a piece of data, the US jobs report comes with an earnings number that continues to show an acceleration in wage inflation. If we saw a much stronger inflation data print, if we saw a really strong retail sales picture that suggests that the money that's been given to workers in response to the tax cuts, if that seemed to be driving a very aggressive acceleration in retail sales, it's hard to imagine that markets wouldn't worry again that interest rates might have to go up more quickly and that 10 yields might steepen. And that, albeit ultimately it may be okay for the equities that bonds yield for, but I think it would be choppy waters getting there.
Okay, so another argument was, that this wage inflation, this was the initial shock, the 8-year high number, that a huge amount of young people in America between sort of 20 and 30 are unemployed, but they're not actually registering for unemployment benefit. So suddenly they're actually off the system, if you like.
Yep.
And what they're saying is, if there is pressure on the wages, that you might get this populace coming back into the working environment, and therefore slowing down inflation. Any thoughts on that?
Yeah, absolutely. So the participation rate has been low in US employment for a long time. And the question is will better working conditions, better pay rates bring people back into the workforce? And will that ease the issue of wage inflation? And we really just don't know the answer to that. What we also know is that quite a lot of families have been working 2 or 3 jobs because, there has been significant pressure on wages. So there's a lot of puts and takes on that at this point in time. And we just don't see. What I'm saying is I just feel it's all very convenient that markets have steepened exactly to where everybody can live with it comfortably. Market got into a mindset that yields were going to be 3% before they got there, and they haven't even got there actually. And if you saw how the market traded last night, 10-year treasuries fell back a little bit. They've drifted back into the 280s, and stocks have had a really good day again. Middle of last week, a little bit of confusion on the Federal Reserve minutes. Was that telling us there's going to be 4 rate rises? Does that really matter? Bond yields looked like they were going to 3, spiked up a little bit, and markets had quite a sort of wobbly day. So I think we're going to continue to be completely in the hands of the bond market for some time in a year where there's a lot of Treasury issuance coming forward to fund a lot of Mr. Trump's plans.
Historically, you've said about you like the banking sector, you like the commodity sector. Any other themes at the moment have changed or reiterated your stance in the last couple of weeks?
No, not particularly. So we've continued to like banks, and we had some quite reasonable results from Standard Chartered back on the dividend list finally this morning. That's good news.
Yep.
A conference call was on as I was leaving the office, so haven't really heard the details of that, but the markets reacted initially okay to that. There's been some other good results, DPS in Singapore, which we only had really good results. Big bump in their dividend, paid a special dividend. That's what the market really likes. of course, from the banks, seeing them using capital well. So that's still a good theme for us. We've been adding to what one might call old technology in the US. So on Cisco's really good results, you know, they increased their dividend by 14%. They significantly upped their share buyback. And they started after a long, long period of time of declining revenues because of their legacy businesses starting to show some top-line growth. And so some of those tech stocks have really been repriced, actually, as they've started to grow again, having not been the sort of market darlings, because people want, when they invest in tech, they like to invest in really exciting technology that is growing its top line very fast. And Cisco's been steadily rebuilding its franchise and just getting going again. And the market's repricing stocks like that at the moment.
Well, I've got to say, you made me feel old then, old technology. And on that note, Tim, we run out of time. Thank you.
Thanks very much.